Good morning, good afternoon, good evening, wherever you are. This is Lawrence Benstorp from Trading Mastery School, and I have a big announcement for you all. There's my new book over here, which just has got released, and it's called Trading Retirement Accounts: Automated Systems to Make Money in Bull and Sideways Markets, Preserve Your Wealth in Bear Markets, and Guard Against Inflation. So this is all about systematic trading. And systematic trading is basically rule-based trading. And this is where we are having a structure and rules that help you to protect and profit from your wealth for different market conditions. So through simple mathematical formulas, we define what to trade, when to enter, how much to buy, how much to sell, and when to exit. So this process is then automated through software, and it tells you each day before the market opens what to do, how much you need to buy, what stock you need to buy, what stock you need to sell. And this last part actually can be automated as well. So in my case, I trade 55 systems all simultaneously, completely on autopilot. Now, in my new book, we only go into 7 systems, and I'm going to explain to you a little bit more what you will see in this new book. So, trading retirement accounts has its limitations, of course, since often we can trade long only. Brokers can be a little bit more having limits as far as what you can do with your retirement accounts. So, therefore, we focus on making sure to diversify systems as much as possible. So, we focus on having different systems on different sectors or portfolios. So technology sectors, energy, healthcare, and stuff like that, or the overall S&P 500s. We want to make sure that we have for every system very different entry rules. So we want to have different rankings. And when you're wondering, like, what are rankings? So often we have a lot of candidates that we can trade through our algorithms, and then we need to choose a rule of priority of what will be the actual stock that we can trade if our money management say that we can only trade 10 stocks. And then the ranking comes into place. Like, for example, we only trade the 10 stocks with the highest rate of change or the highest volume. Um, we focus on different lookbacks to make sure that we have systems that have short-term lookbacks where we capture a trend very fast, and other systems where we have a longer-term lookback as well. We also focus on systems that are very overbought or oversold, and that we buy them. When they snap back, they revert to its mean, and we sell them then. So we try to diversify it as much as possible in time frames as well. And we also look to trade at the same time different asset classes as well. So in my new book, you will get 7 quantified systems with all rules revealed, all developed for a different purpose. So, and to give you a little bit of an example how this works and how this all combines, let's say we have a system number A over here, which is a long-term trend following system, where you see that with the equity curve looks quite nice, has a compounded annual growth rate of almost 20%, but the maximum drawdown is 33%, and the longest drawdown is 32 months. So quite a big drawdown still, right? So that is something, if you trade only a single system, that you're going to deal with, period. Now, what if you're going to add to a system like that another system that is designed for a complete different purpose? And in this case, this system is designed to do very well in inflationary markets. It trades on a complete basket of different ETFs, which are very much non-correlated to the overall stock market. And although you see that the compounded annual growth rate and the maximum drawdown are not impressive at all, but now let's take a look if we want to combine this. So what if we combine this? So we see in this table over here, if we have the trend following system by itself with the 19.9% CAGR, and then we have the diversified instrument systems with only 5.1% CAGR. What if we combine those and we trade only 2/3 of our portfolio for that trend following system on equity and the other 1/3 on the diversified instruments portfolio? Now, if we trade those two systems combined, just because they are designed to make money at different time periods, now suddenly, although the compounded annual growth rate is a little bit lower, 18.2%, but take a look at your maximum drawdown. It suddenly dropped from 33% to 22.6%. Your longest drawdown dropped from 32 months to 23 months. And the MAR, which is the compounded annual growth rate divided by the maximum drawdown, moves up to 0.81. And these are simple, straightforward systems. So this is the power and the magic of combining non-correlated assets. So we're going to focus in this book on two different styles, trend following and mean reversion. And we will start with the trend following. And it's totally fine if you say, for example, well, I'm a trend follower by nature, and that's all I want to trade. Totally fine. You can just decide to only trade trend following. I think there's a lot more upside if you do other styles, but this is here like an ideal trend following system where you're basically entering over here. You've got your stop loss at a low price below your entry, and then you just ride that whole trend until it eventually bends. This is the perfect trade for that, of course, where you would have bought at 17 and got out at 120. And I'm sure that people who had strategies like this, that they were in this particular trades. Now, mean reversion is a complete different style. We often look for an uptrend. We then look for a pullback to the downside. We then intraday wait until the stock even gets pummeled more. We buy then with the expectation that it will revert to its mean. Once it has reverted to its mean, we will exit. So this is actually a strategy that is not going to be in the market very long. And this is, of course, a strategy that complements a long-term trend following strategy very well. And it is a strategy that needs to trade a lot. Very different in style. You can trade both at the same time. So we have 7 systems in the book, and let's take a look at system number 1, which is trend following on the S&P 500. So this system needs to make money when the overall market is in a big bull market. We will be looking for longer term trends, both for the S&P 500 index and for the stock itself. And then we want to be in the strongest performing stocks of the S&P 500. So once we're in, we want to give these stocks some space to continue the trend and make sure that we ride the trend as long as it's trending up. Once the trend is over, we exit, period. Now, the good thing is that the research that I'm going to show you in this particular strategy is going back all the way to 1960. So here is the equity curve for that, and the compounded annual growth rate is around 17%. You do see that there is a significant drawdown in there as well, which is, of course, in 1987. But you also see that it makes money exactly when it is supposed to make money in the bull markets. And that's what we want from this strategy. Of course, you're going to get all the rules of all strategies for this. So system number 2 is a long-term trend following system on NASDAQ stocks. And the objective over here is that we want to diversify by stock universe. So instead of trading S&P 500 stocks, we want to be in a different sector. In this case, we want to be more in technology stocks. They move faster. They can move stronger as well. They can have strong drawdowns as well. We also want to make sure that we diversify by entry frequency. And that means that with this system, we're going to enter a little bit earlier, and there's specific rules for that. So we aim to avoid getting into the same stocks, and therefore we have also a different ranking. There could possibly be some overlap of returns in strong bull years. So here are the backtested returns for this specific system. And you see that it makes phenomenal money in bull years. And as expected, in bear years, yes, it's going to give back money. But remember, this is only the beginning. Okay, we need to see how this all is going to combine. So system number 3, and I showed you this one, this is all about a system that trades on a basket of ETFs. And in this case, it is designed to hedge ourselves against inflation. Possibly there could come another wave of inflation. Who knows? Nobody really knows. But there was big inflation in the mid 2020s until 2022. And you see how this system at that time was really shining, even when the markets in 2022 were doing very bad already. The same in 2007 and the beginning in 2008. This system was actually making money. It was in other sectors like gold, agriculture, and stuff like that. And I'm going to teach you exactly how that looks like. So these 3 systems, what if we would combine them and trade them at 33% each? So the first system that I showed you is that S&P 500 trend following system. The simulation from 2003 to 2024 is 19.9%, maximum drawdown 32.9. So we add that NASDAQ system to it with a 23% compounded annual growth rate, a little bit of a larger maximum drawdown as well. To be expected, you have a larger drawdown, but also a higher return. Return and risk go in line with them. Then we add that system to it, which I call the inflation hedge, which really is very non-correlated. And if we trade all these 3 systems at a third of our equity at the same time, our compounded annual growth rate goes to 18.2%. So a little bit lower if only you would trade the S&P 500 system. But take a look at the drawdown at only 22%. And trust me, if you trade a system that has a 22% drawdown or a 40% drawdown, that could be the difference for you suspending that system or actually saying, I'm still comfortable with this and I will continue to trade this. Now, this is only a part of the trend following. We also going to add an energy system to this. So in system number 1 and system number 2, we focused on the broader market with relatively long look backs. System number 3 was created with simple trend rules with ETFs. Now in this new system, we aim through sector diversification to trade a portfolio that possibly contains stock that act very different than the broader market. And I chose in this case to only trade energy stocks. So that's not to say that there's anything magic in the energy sector, but I know that this specific system by itself was not performing that great, but it did make very great money on a simulation in 2022. Also, what we want to have is a faster entry on the trend and on the exit. So the first 2 systems, we look for longer look backs. Over here, when there's only the slight sign of an uptrend, we're in already. A third rule to make sure that there is zero overlap with any other systems is to make sure that we diversify by liquidity. So the first two equity systems are all focused on big indices, pretty liquid stocks, while this system will look at other stocks that are less liquid, and there's many variations that you can use for this. So now we go over to the mean reversion part. And I would say that the first system I would call catch a falling knife in an uptrend system. So while LTTF systems, so while trend following systems tend to have long duration trades for those positions that are performing well, mean reversion systems are short, generally lasting 2 to 5 days, sometimes even only 1 day, but generally not that longer. You want a fast turnover of trades because you only grab a little bit of the profits and then you get out. So you want to have a large number of trades. Consequently, a long-term trend-following system is likely to execute very few trades a year, while a mean reversion system may have 200 or 300 trades or more even. So rather than try to make a lot of money over a long period of time on a single trade, mean reversion systems aim to make a little money over and over again, which can add up to a nice compound annual return. So mean reversion systems can complement trend following systems, particularly in sideways markets where there are not clear upwards trends. Generally, there is a chance as well that in big bull markets, they underperform a little bit versus the trend following systems, but that's fine as well. It's all how they combine, of course. So then we have another mean reversion system, and this is one that I particularly like myself. Um, if you're not in the market when it starts to fall, you won't lose money, right? That makes sense. So how do we accomplish that? So with a simple filter that prohibits us from placing entry orders at the first sign of market decline, we do that with a shorter look back filter. So the objective is to buy upward trending stocks on a pullback and limit potential downsides, preserving capital. And that means two things. Only buy when the market as a whole is in an uptrend, and make sure that if there's even the slightest sign of a possible extended sell off, do not place any new orders. So have a very short time duration so that if the market sells off and you have some position open, that they are not dragged down for 4 or 5 days, but limit the pain and get out very fast. So the whole objective is to not be in the market when the carnage happens, like during COVID, during the last 2 months, for example. So this lowers the combined drawdowns because all the other systems are losing during that time. Then we go to our last system, a healthcare system. And again, I chose this sector because I like to have also a system on a set of stocks that are a lot more volatile and that will give us good options for mean reversion. So our first two mean reversion systems trade in the universe of all stocks, and our trend following systems are trading the S&P 500, the Nasdaq, commodities and energy stocks. Since we look for more diversification, we're going to focus here on healthcare stocks. Why healthcare? Well, at certain times, the healthcare sector is negatively correlated to the broader markets, which is a good thing. So think about happened during the pandemic when some healthcare stocks did exceptionally well. Now, this is important. It's not a given that they're always negatively correlated, not at all. So there are times when there is so much panic in the market that all long systems or all sectors are basically going down. So it is not a guarantee. If there is huge panic to the downside, there's always a chance that every sector goes down. But at least we want to try as much as possible to diversify ourselves amongst completely different sectors. So the objective is to buy stocks that have the possibility to be non-correlating to the overall markets and volatile, giving us many opportunities to profit through mean reversion. So simulation since 2003, this is all based on back-tested return. We have, let's say that we allocate half of our money to the trend following part. So we have those 4 systems. We have a compounded annual growth rate of 18%, maximum drawdown of 23%, and a MAR of 0.76. And longest drawdown, 29.6 months. Pretty good. And if you're a trend follower only, totally fine. Now, we can add also 50% of our money to mean reversion systems. Those 3 systems that I just showed to you, all the rules are in the book, of course. They have a compounded annual growth rate of 22.8%, maximum drawdown of 19.3%, pretty nice MAR. I explained very clear as well what the pros and the cons are of trend following versus mean reversion. So if you buy the book, pay good attention regarding that. But what is important over here is to take a look if we combine these 4 trend following systems and these 3 mean reversion systems. So we're allocating only 100% of our equity, which we can do with IRA accounts, of course. So with retirement accounts, we can only trade up to a maximum of 100%. So combined returns, compounded annual growth rates, 20.4, maximum drawdown 15.8. And you see how the MAR suddenly jumped up and the longest drawdown got a lot lower as well. Now that's the magic of combining different styles and different philosophies, different portfolios, different sectors. This is how the blend of those 7 systems combines. So there's a bonus as well. So if you sign up for our free video course, I'm going to give you the link to that. You additionally get 5 systems that are designed to make money when the market goes down, like what is happening in 2025 right now. It's very hard to make money on long systems only when the market is going down the whole time. But if you combine these 5 systems, and I reveal all rules to that as well, you get the best of both worlds. So here's the magic of combining different styles and different directions. So we have the 7 long systems combinations from my book, Trading Retirement Accounts. And I have updated them over here until the end of April. So the CAGR got a little bit lower and the drawdown a little bit higher. And that is because of the recent price action. But it did perfectly what it was supposed to be doing. And the long systems, they're about flat right now. Their exposure is maybe only 10%, of which a little bit is gold, for example. And if we add to that 5 bear market systems, and you need to trade this on margin, you need to trade this on a non-IRA account. To be able to do that, there's one system that you could trade in the IRA account. You could use futures as well in some of the IRA accounts, but generally your broker is going to require some margin for that. But let's say we're going to trade that allocation 100% long the 7 systems and 5 of the bear market systems at 100% short allocation. And you see that the compounded annual growth rate is only 6%. The maximum drawdown is 30%. And many people think like, well, why would I trade something like that? Of course, we need to understand that our sample size is fairly bullish since 2003. But if we combine that, suddenly our compounded annual growth rate moves up to 27.5%. And the simulation shows a maximum drawdown of 13.5%, a MAR of 2.04. This year, the system is up. It's making money. And that is a typical thing if you're trading short selling systems that are doing very well when the market starts to go down. So you see the difference. 8.4% more compounded annual growth rate, 3.3% less drawdown, and the MAR drops a lot. Calculation was wrong over there. It's plus 0.9, by the way, but significant increase. So here's what I would like you to do next. So if this is something you'd like to know more about, go to Amazon.com, type in trading retirement accounts or my name, Lawrence Benstorp, and you will see the book. And you see the picture over here of the book. And you can buy the Kindle version there for $9.99. So for less than $10, you get 7 of the systems, and there's a lot of hugely valuable information in there. So just go to Amazon and look up the book over there. Also, for your bonus, so if you want to have your bonus where I'm going to go in deeper into the 7 systems from the book, but I also add 5 systems that are designed to profit in bear markets, crashes, and depressions. And I show backtests and research that goes back all the way to 1928. And that's something that you definitely want to take a look at as well. Then you want to make sure that you go to the link that you see over here, tradingmasteryschool.com/book-offer. And over here at just fill in your name and your email, and you immediately are getting to the membership part. You will see all the videos over there. They are free. There's no cost at all for that. I really hope that you're going to enjoy my book, and I hope you're going to enjoy the free video course as well. There's a lot of information in there, 12 complete systems that are all designed for different kind of market types. And I wish you a lot of fun with that. And I hope to see you inside the video membership area. Thanks a lot and take care.